Okay, here we go with another Gino gem because that's what I do. I throw out little nuggets that help your trading life. This is one where I'm going to talk about, is everything equal when it comes to mutual funds? Are we all equal? Are we looking at the right picture? This is something, if you haven't done it yet, you have to add to your watch list. This is equal weighted markets versus the normal market. If you're not sure what that is, I'll show you. But there's a lot of ways to use this, and it has to be part of a trader's repertoire because it's part of mine. Let me show you what I mean. So real quickly, looking at this graph right here, would you call this bullish? Is that a breakout? Yes or no? If I go like that, that's a breakout. At the yellow W pattern, that's a breakout. Which one's more bullish? This one, we'll call that chart A, or this one, chart B. This one is not broken out. It's got this downtrend. It's got lower highs, and it's pulled back to the moving average. In fact, it's got lower lows down here. So that's definitely not as bullish as this one. Which one's more bullish? Well, be careful how you choose because they're the same index. This is the NASDAQ 100 right here. And yeah, that's breaking out. This is also the NASDAQ 100 right there. It's not breaking out. It's in a downtrend, struggling with this overhead resistance. How can it be the same index? How can that be? Will you ever have one of those days, and maybe you've noticed this, maybe you haven't, when you wake up and the NASDAQ, like here, is down, and so is the S&P, but you go look at the advancers, and there's more advancers in the market. More stocks are up, but the markets are showing a down number, a down percent. How is that possible? Because in case you don't know it, the markets are weighted differently. So basically, if you went out and bought the S&P 500, you can see my chicken scratch right here. The first 10 stocks of the S&P 500 make up 27% of the move. So basically 7% in Apple, 6.2% in Microsoft, and you can see it broken down here. It's favored on the biggest companies, the mega caps. It's favored by what's called market cap. So basically, if you were to copy the S&P based on the chart we looked at, the market cap weighted, 7.1% of your money would be in Apple, 6.23% would be Microsoft, and so on and so forth. Think about this. What about the other 490 stocks? You start getting down to the ones down there with small market cap, you're not really putting that much in them. So is it balanced? No, it's not balanced. It's called market cap weighted. The S&P chart and the NASDAQ chart and the Dow are not equally balanced. So if you're to equally balance your money, it would look like this. It would be S&P 500 equal. You would have 0.23% of your money in all the stocks. And of course, top 10 holdings would only be 2.29% of the total assets. Check this out. The NASDAQ 100 top 10 holdings are 55%. That was the chart we were looking at that was breaking out. And why was that? Because NVIDIA is breaking out today. Let me just show you quickly what that looks like. It has a big effect on the market. So if I come in here, I put NVIDIA, which is 5% of the market. You can see NVIDIA breaking out. So yes, it's going to affect the Qs, but guess what? It's not going to affect the Qs equal weighted nearly as much, because when you look at the equally weighted, everything's about 1%, just over 1%, even. So it's not going to move that index as much. It's equally weighted. Looking at the S&P for the year, the market cap one's up 9%. The equally weighted is only up 2.5%. See the difference? So if you spread out and evenly divided your money up on the stocks, it wouldn't be as volatile and it wouldn't be favored by the mega caps. In the NASDAQ, same thing. It's up over 20%, but if it's equally weighted, it'd only be 12%. So is it bullish, yes or no? Looking at the Russell, guess what? The IWM, it's one of the most evenly balanced, even though it's market cap, because they picked the ones that are in the center of the 2000. It's already evenly balanced. So there's a big, big lesson there that, number one, are you looking at the true market? And number two, you should be looking at both. And for example, here's my equally weighted watch list. When I look at The S&P, I always make sure I look at RSP. RSP has not broke out. SPY, SPX has, which means not all the stocks have broken out. They're not all bullish yet. Just like I showed you in the beginning, the Qs has broken out, but has it? Because I'm looking here, it's not every stock in there agrees. So you have to look at the internals. And finally, here comes another Gino gem. SPY, $417. The market weighted, equal weighted SPY RSP is only 146. Therefore, it's cheaper, easier to buy and trade, and there's options on it just like the SPY, which means the options are cheaper. You got the Qs up here at 323. You got the equal weighted down here at 98. It's cheaper, very similar charts, a little more true to the market weight, and they have options and the same volatility. It's almost an identical twin. It's just equally weighted, not as volatile. Let me throw another one in there. Biotech, I like to look at the equal weighted biotech because, as you know, that's a gapping index. A lot of options in here, a lot of ways to do credit spreads without the volatility of one player. There you go. Take a snapshot of my watch list of equal weighted. There's so many ways to learn about how to trade equal weighted indexes. It's something you should be looking at. It's something you should be trading with options. It's much, much more consistent. Learn more at tackletrading.com.